Do you have senior clients that could benefit by the amazing home equity conversion mortgage line of credit feature? Hello, this is Brian Fisk with Reverse Mortgage Strategies. I want to talk briefly about the home equity conversion mortgage, or HECM, line of credit feature. The line of credit figures into a number of possible scenarios, some of which I discuss in other videos, but I want to briefly review the features and benefits of this really unique financial tool. A HECM borrower is not required to pull out all of their proceeds at loan closing. They can withdraw as cash whatever equity is available in the first year, or however much cash they have an immediate need for, and leave the remainder as a line of credit to be drawn upon whenever they need funds. The line of credit is guaranteed by FHA. Access to the line of credit cannot be reduced or frozen like a bank HELOC or home equity line of credit. With a HELOC, if there is a downturn in the real estate market or your financial situation changes due to loss of employment or even divorce, or if your credit rating takes a hit, the home equity line of credit lender can reduce or possibly freeze that line of credit, possibly right when you need it most. With the FHA insured line of credit, FHA guarantees that this line of credit will be available for as long as the qualified borrowers occupy the home, potentially for their entire life. Again, a big difference compared to a HELOC, which typically is available for 10 to 15 years only. The HECM line of credit grows each year. This growth is not based on a projected increase in the value of the home. It is FHA guaranteed and based on a Treasury bond index. What this chart shows is that if a borrower took out a $400,000 line of credit on a $1 million home and the line of credit grows at 5.5% per year, the rate at the time of this video, after 10 years, the line of credit has grown to $718,000. After 20 years, it's grown to $1,371,000, and after 30 years, that line of credit would grow to over $2.6 million. This line of credit growth is based on the increasing age of the borrower. The older you are, the more home equity you have access to. This is very powerful and one of the main reasons that reverse mortgages are more and more being utilized as a financial planning tool. Withdrawals from the line of credit are not income taxable since you are tapping into your own home equity. And of course, there is no mortgage payment on the HECM line of credit. The loan balance is paid off when the home is sold, either by the borrowers during their lifetime or by the heirs after all the borrowers have left the home. And as with all reverse mortgages, this is a no-recourse loan. Neither the borrowers or their heirs are ever responsible for any amount greater than the value of the home. At any point in the future, the line of credit can be converted into a monthly payment for a guaranteed lifetime income or a specific number of years. This lifetime income option is not for all situations, but is very powerful because of the double benefit of the growth of the line of credit and the fact that the borrower is getting older, and so the income from a life annuity is greater the older the client. In our proposal, if the borrower took a lifetime income after year one, they'd get $3,966 per month. If they didn't need income for 10 years, because they're 10 years older and the line of credit has grown for 10 years, they'd get $7,814 per month. And after 20 years, the income would be $22,006 per month. This future income potential can provide a great comfort for seniors with any concerns about outliving their resources. Another amazing feature of the HECM line of credit is that if a borrower chooses to pay down their loan balance, each dollar paid against the loan balance increases the line of credit available dollar for dollar. Let's say you have a borrower with an immediate need for funds, but they do have the ability to pay that loan balance down, either because they're still working and have the income to pay the loan down, or they choose to pay the loan balance off with other funds that become available. Each dollar paid against the reverse mortgage loan balance increases the line of credit by $1, and the power of monthly compounding results in the line of credit growing that much faster. And while the borrower has the option to pay down the loan balance, that is at their own discretion. No payments are required on the loan balance or the funds accessed through the line of credit. It'll be paid off when the home is sold, either by the owner or the owner's heirs. And full disclosure, for an eligible non-borrowing spouse, a spouse that lives in the home but is not 62 when the reverse mortgage is taken out. The line of credit feature is no longer available upon the death of the borrowing spouse, so those funds would need to be accessed while the borrowing spouse is still alive. I'm Brian Fisk at Reverse Mortgage Strategies. This is a brief review of the FHA insured HECM Line of Credit. For any questions about how this amazing financial tool can benefit your clients or to run an illustration for a client, call me at 818-425-2058. Thank you.